Hello everyone, welcome back. In this video, we are going to continue and wrap up our discussion of income types, starting with alimony as our next income type. So for tax purposes, alimony is defined as a transfer of cash made under a written separation agreement or divorce decree. The separation or divorce decree does not designate the payment as non-alimony. In the case of legally separated or divorced taxpayers under a separation or divorce decree, the spouses do not live together when the payment is made, and the payments cannot continue after the death of the recipient. Other important things to know around alimony income: types of payments that do not qualify as alimony, so do not qualify, are property divisions, and then any child support payments fixed by the divorce or separation agreement. So the calculation of alimony, for the most part, can be pretty straightforward. The big key with this one is the date of the divorce or separation agreement. Because that date, and I highly remember you get this date stuck in your head, the date will dictate how that alimony is treated by both parties. So right here on the slide, for divorce or separation agreements executed before January 1st, 2019, alimony is included in gross income of the recipient. So included in gross income of the recipient, and deductible for AGI by the payer. For divorce or separation agreements executed after December 31st, 2018, alimony is not taxable to the recipient, and it is not deductible by the payer. So that is why these dates are super important, because unless there are discussions about property divisions or child support, that could complicate an alimony problem if there was something like it on the exam. The big key we would need to remember is the dates, because that date will dictate if there is even any gross income that needs to be recognized. All right, so let's look at an example problem related to alimony. So Lanny and Shirley divorced in 2018 and do not live together. That's good to know. Shirley has custody of their child, Art, and Lanny pays Shirley $22,000 per year. All property was divided equally. So the first thing I want to point out, just with the initial fact pattern, we see that Lanny and Shirley were divorced in 2018. That is good to know, because if that said they were divorced in 2019 or later, that would make this problem super simple, because any divorce agreement dated 2019 and later alimony is not considered to be a part of gross income. So then our problem would be very simple. But since it was in 2018, we have some math to think about. So let's look at each scenario in here independently. So scenario A, how much should Shirley include in income if Lanny's payments are made in cash, but will cease if Shirley dies or remarries? So here, the amount that is includable in Shirley's gross income as alimony is $22,000. So they mentioned that in the problem here. Whoops. In the fact pattern. And the reason why it is $22,000 here is because the payments do not continue after Shirley's death, and it is not important that the payments may cease earlier than Shirley's death. So $22,000 will be included in the first scenario. Scenario B, how much should Shirley include in income if $12,000 of Lanny's payments is designated as non-alimony in the divorce decree? So back on the previous slide, we mentioned that amounts designated as non-alimony in the divorce or written separation agreement are not treated as alimony for tax purposes. So in this scenario, if we know $12,000 is designated as non-alimony, then we need to take our full $22,000 payment, then back out or subtract that $12,000 of non-alimony, because that is not supposed to be considered as alimony for tax purposes. So then that leaves us with $10,000 that would be includable in Shirley's gross income as alimony. Here, I'll underline this answer too. All right, now part C, and then this is independent as well. How much should Shirley include in income if Lanny's payments drop to $15,000 once Art reaches the age of 18? So whenever we see something like that, where if a payment drops once a child reaches a certain age, that would be indicative of a child support situation, because a part of the payment ceases upon the happening of a specific contingency related to the child. In this case, Art turning 18. So, if we know the payment drops to $15,000, that would mean $15,000 is now our new amount to be includable in gross income as alimony. Because then, if we're receiving $22,000 a year currently, and the payment drops to $15,000 once Art turns 18, this $7,000, that difference is our child support. All right, our next type of income that we're going to talk about are prizes, awards, and gambling winnings. So these ones are pretty straightforward. You would recognize whatever the amount is, unless a certain exclusion is applicable to those prizes, awards, or gambling winnings. So this one, there isn't necessarily a computation to really think about. It's more of, do we know what the exclusions are? So that way we can discern whether or not this income needs to be recognized on the tax return. So these exclusions for prizes, awards, and gambling winnings, those are excluded only if those were made for scientific, literary, or charitable achievement under certain conditions, for employee length of service or safety achievement, and there is a $400 tangible property limit per employee per year, or if the prizes or awards were made to Team USA athletes from the United States Olympic Committee on account of their competition in Olympic and Paralympic Games. And there are AGI limits that apply to those. Additionally, in regards to gambling, in some states, gambling is illegal. If you were to gamble in one of those states where gambling is illegal and have gambling winnings, you would still have to recognize those gambling winnings in your income, even if it was illegal. Our next type of income we are going to cover is Social Security benefits. So once you reach a certain age, you are eligible to take Social Security benefits. And for these, there are lots of rules surrounding how much in Social Security benefits are considered a part of your gross income. So what we're gonna do for this one is we're gonna just walk through the decision tree, because it's kind of whenever you read the options in the decision tree, it sounds a little lengthy. And then what we're gonna do is we're going to work an example problem demonstrating what would happen under all three options of the decision tree. So I apologize, but since the Social Security part is pretty technical in how it needs to be calculated and approached, we're just going to go through it word for word. So, Social Security benefits. Those are taxable up to 85% of Social Security benefits in gross income, depending on the taxpayer's filing status, Social Security benefits amount, and their modified AGI. And this modified AGI, we're going to define that down here. So modified AGI is your regular AGI, excluding 50% of your Social Security benefits, plus any tax-exempt interest income, excluded foreign income, and certain other deductions for AGI. Alrighty, so let's get into the decision tree for how to calculate taxable Social Security benefits. So in the slides, we're gonna look just at single taxpayers. However, it is important to note that for married filing joint taxpayers, the decision tree that we will go through is the same. The only thing that will be different are the bounds that are used. So like in this first example here, where we're talking about if the item is less than $25,000, for taxpayers filing married jointly, it would have all of this exact same text, except this would say less than or equal to $32,000. So same steps, just different bounds. But we're going to talk in the context of single taxpayers here. So for our decision tree and how we go through the calculations, if the modified AGI plus 50% of Social Security benefits is less than or equal to $25,000, then Social Security benefits are not taxable. Not taxable. If your modified AGI plus 50% of your Social Security benefits is between $25,000 and $34,000, your taxable Social Security benefits are the lesser of, did not mean to make that a squiggle, the lesser of A, 50% of the Social Security benefits, or B, 50% of modified AGI plus 50% of Social Security benefits minus $25,000. And then our final option, if the taxpayer's modified AGI plus 50% of their Social Security benefits is greater than $34,000, taxable Social Security benefits are the lesser of A, 85% of Social Security benefits, or B, 85% of modified AGI plus 50% of Social Security benefits minus $34,000, so all of that together, plus the lesser of $4,500 or 50% of Social Security benefits. So I know that was a lot of words. So what we're gonna do is on the next slide, we are gonna work through a comprehensive problem posing 3 different scenarios, so that way we can go through each option mathematically and put some numbers behind all of these words. All right, so let's look at our example problem. So in our fact pattern, Graham received $7,200 of Social Security benefits this year. What amount of the Social Security benefits must Graham include in her gross income if her modified AGI is $20,000, $25,500, or $31,400? So we're gonna look at each piece and I'm gonna color code them. So let's see, A we'll do in red. Whoops, that was not red. Whoops, so A will be red, B will be blue, and C will be green. All right, so let's look at the first one. So what amount of Social Security benefits must Graham include in her gross income if her modified AGI is $20,000? So the main number that we will want to calculate is modified AGI plus 50% of total Social Security benefits. So for scenario A, our modified AGI is $20,000. Then we want to add 50% of our Social Security benefits. So we want 50% of our Social Security benefits of $7,200. And so then when we calculate that out, so 50% of 7,200 is 3,600 plus 20,000. That gets us 23,600. If we look at our decision tree, and I forgot to mention this part, we are assuming that Graham is a single taxpayer. So assume single. So that way we know which decision tree to look at. So when we look at the decision tree, we see that our modified AGI plus 50% of our Social Security benefits is less than $25,000. So here in scenario A, in this case, our Social Security benefits are not taxable. So then to answer the question, what amount of Social Security benefits must Graham include in her gross income when it's $20,000 as her modified AGI? The amount we include in gross income is 0 for Social Security benefits. Let's look at option B. So now I'll switch to blue. So we have our modified AGI of 25,500 plus, and we need 50% of our Social Security benefits. So 50% times 7,200. And from the previous problem, we calculated this as 3,600. I did not write that number right. That should say 25,500. 25,500 plus 3,600. That should get us, sorry, I'm plugging it into my calculator, 21,900. I totally transposed those numbers. I am so sorry. It is 29,100. I'm sorry for that transposal there. So 29,100. So now when we take that number and we look at our options, we see that that number is between 25,000 and 34,000. So then we will have to use option 2 for calculating the taxable Social Security benefits. So what it's telling us for option 2 is that taxable Social Security benefits are the lesser of A, 50% of the Social Security benefits, or B, 50% of modified AGI plus 50% of Social Security benefits minus 25,000. So we'll do the math for each part, and then we're gonna pick the number that's lower, and then that is what our taxable Social Security benefits are gonna be. So we want the lesser of A. I think I'll write it over here maybe. So A was 50% of the Social Security benefits. So 50% of our Social Security benefits of 7,200. That was 3,600. Then option B is 50% of modified AGI, so that's 25,500, plus 50% of Social Security benefits, in which we determined that earlier, so that's 50% times 7,200, so that gave us 3,600, minus 25,000, because that is our lower bound. So then if we plug all of that into a calculator, so 25,500 plus 3,600 minus 25,000, that gives us 4,100, and multiply that by 50%, and then that gives us 2,050. So then now if we look at which option is the lower amount, it is option B. So our taxable Social Security benefits are $2,050. Throw a little dollar sign in there. All right, last scenario. Option C. What if our modified AGI was 31,400? So if we calculate our modified AGI plus 50% of Social Security benefits number, our modified AGI is 31,400. And then if we add, make that a plus sign, my goodness, Katie. If we add 50% of our Social Security benefits of 7,200, that gets us, plugging into my calculator, sorry about that, plus 31,400, that gives us 35,000. And so now, since this 35,000 is greater than 34,000, we're gonna go through the options for number 3 to figure out the taxable Social Security benefits. So option 3, the taxable Social Security benefits are the lesser of A, 85% of Social Security benefits, or B, 85% of modified AGI, or I guess I should say 85% of, in parentheses, modified AGI plus 50% of Social Security benefits minus $34,000 because that's our bound, plus the lesser of $4,500 or 50% of the Social Security benefits. So let's figure out letters A and B to figure out what our lesser number is. So A is 85% of the Social Security benefits. So pretty straightforward. I'm going to take 85% and then multiply that by 7,200. And that should get us, oh, I gotta pull out my calculator again, 7,200 times 85%. And that gets us 6,120 as our option A. Now option B. That is, so the starting part, 85% multiplied by modified AGI, so that's 31,400, plus 50% of our Social Security benefits, so 50% times 7,200, that gets us 3,600 minus 34,000 plus the lesser of $4,500 or 50% of our Social Security benefits. So for that last little piece that we need to add, we are comparing $4,500 or $3,600 because that is the 50% of our $7,200 of Social Security benefits. So the lesser of those two numbers is 3,600. So then if we work out all of that math, all right, so hold on, this is a lot of math. So 31,400 plus 3,600 minus 34,000, so that equals 1,000, times 85%, that gets us 850, plus 3,600, and that gives us a final number of 4,450. So then, whenever we compare A and B, we want the lesser of our two options. So in this case, option B is our lower number. So here I'll throw a $sign in there. So in scenario C, our taxable Social Security benefits will be $4,450. All right, our next type of income is called imputed income. And this happens when employee discounts or low interest loans generate income via indirect benefits. And so for low interest rate loans, and that will be the example that we work in a couple of slides, the amount of imputed income is the difference between the amount of interest using the applicable federal interest rate and the amount of interest the taxpayer actually pays. So on those low interest loans, if we look from the borrower's perspective and the lender's perspective. So from the borrower side, they're paying imputed interest. So it's an expense to the borrower and income to the lender. And then the lender on their side, they have returned the imputed amount. And then for imputed income, an important thing to keep in mind, I'll actually make it a highlighter. Imputed interest rules do not apply to aggregate loans of $10,000 or less. So if you're looking at a problem, if the loan is $10,000 or less, then we don't need to worry about imputed interest rules. All right, so let's look at an example related to imputed income. So at the beginning of January, EWD provides Courtney with a $100,000 zero interest loan. Assume the applicable federal interest rate, compounded semi-annually, is 4%. Courtney used the loan proceeds to acquire several personal use assets, an automobile and other things. What amount is Courtney required to include in gross income in the current year? So, what we mentioned a couple of slides ago was that for low interest loans, the amount of imputed income is the difference between the amount of interest using the applicable federal interest rate and the amount of interest the taxpayer actually pays. So I'm going to write that out real quick so we have it handy. So our formula is interest with federal rate minus interest actually paid. Interest actually paid. Okay. So let's calculate each piece. So in the problem, we have a $100,000 loan. The federal interest rate is 4%. So if we plug those pieces in, our interest amount using the federal rate would be $100,000 times 4%, which would be $4,000 minus the amount we actually paid in interest. So that number, again, we have our $100,000 loan, and we paid zero interest on it. So then if we plug in those numbers, 100,000 times 0%, that gives us 0. So then the amount of imputed interest income we have to include, $4,000 minus 0, That gives us $4,000 we have to include. All right, the last type of income, I appreciate you guys sticking with me. I know there was a lot of income types we talked about. The last income type we are talking about is discharge of indebtedness. So what that means in plain English is a taxpayer's debt is forgiven by a lender. That is what discharge of indebtedness is. And so when that happens, the taxpayer usually has to include the amount of the debt relief in their gross income. However, there are certain exceptions that do exist. And an important thing to keep in mind is usually with this discharge of indebtedness, the whole point of forgiving debt is to try to help the taxpayer get a fresh start. So, something to keep in mind for this particular one if tax relief is provided to an insolvent taxpayer, so if the taxpayer has liabilities, including tax liabilities, that are greater than their assets, then that discharge of indebtedness is not taxable. So we forgave their debt, but their debts are still so large that it would be unfair to the taxpayer to tax them on any money they received from debt forgiveness if they're still in a ton of debt. On the other hand, if the discharge of that indebtedness makes the taxpayer solvent, so they were able to pay off all their debts and they have some extra cash left over, then the taxpayer will recognize taxable income to the extent of their solvency. And I'll put this in red for the other ones. And then the last piece for this one, regardless of solvency, taxpayers are also allowed to exclude from gross income most discharges of student loans after 2020 and before 2026. Can exclude. All right, I appreciate you sticking with me. Now, in the next 3 videos, we are going to talk about items that can be excluded from gross income. So we're going to explore in depth some of the exclusion provisions and why some of these items are allowed to be excluded from gross income.